Hi everyone, welcome back to another lesson. If you're new to this channel, my name is Farhan and I help accounting students like you ace your exams. Today we have got a past exam paper, which is paper 1 multiple choice questions from May-June 2021 exam, and this paper is specifically for the IGCSE Accounting subject code 0985. But even IGCSE Accounting 0452 students can also benefit because it is the same learning. You can see the questions on the left-hand side of your screen, and on the right-hand side, we'll have all the workings, which I'll go through and explain to you step by step. What I mainly need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. Which statements about bookkeeping and accounting are correct? So starting with the first statement, accounting is performed periodically rather than daily. What does this mean? So bookkeeping refers to the recording of day-to-day transactions within the business, right? And all these transactions are then summarized in a trial balance. Given that the trial balance has been prepared correctly, then the accountant can use this trial balance to prepare the financial statements, which are the income statement and the balance sheet, right? But this is only done after the trial balance is prepared, and the trial balance is only prepared at the end of the period. Therefore, we can confidently say that accounting is rather performed on a periodic basis, but bookkeeping is done on a daily basis. Therefore, statement 1 is correct. What about statement 2? Accounting relies on having accurate bookkeeping records. Absolutely. Whatever trial balance has been prepared after the journals, after the ledgers, after all the correction of errors and the adjustments have been done, we are using this updated trial balance to prepare the financial statements, which are the income statement and the balance sheet. Therefore, our income statement and the balance sheet is dependent on accurate trial balance, which is again dependent on accurate bookkeeping. So therefore, statement 2 is definitely correct. What about statement 3? Bookkeeping includes the preparation of financial statements. Absolutely not. Bookkeeping refers to the day-to-day transactions that we record. But preparation of financial statements are done by the accountant, by a professional, by someone like you who will eventually prepare the financial statements in the future. What about statement 4? Bookkeeping involves the recording of financial transactions. Absolutely, we have already validated that. So therefore, the correct choice of answer to select for number 1 would be option A, which is to select statements 1, 2, and 4. Now let's move to the second question. What increases owner's capital? Now, if I can have your attention to the right-hand side where we have got all the workings. Now, I need you to understand how everything adds up. So when we think of accounting and when we think of the statement of financial position or the balance sheet, the statement of financial position shows us what? That the total of all assets must equal the total of all capital, which is also synonymous to equity, and the total of all liabilities. In fact, this is the fundamentals of accounting. All assets must be either financed through liability or financed by our own capital money. All right. Now, if we rearrange this equation and make capital the subject, then capital can be derived as the difference between total assets and total liabilities, right? So based on this equation, we can clearly see that capital can only increase when there is an increase in assets, and capital can only increase when there is a reduction in liability, right? So on that basis, now within each of the options that are provided to us, we need to scan through and assess whether there is an increase in assets or whether there is a decrease in liabilities. So let's start with the first option. Bank loan extended from 5 to 10 years. So no monetary event has actually taken place, but rather the duration has been extended. So there are no assets or liability accounts being affected. Therefore, capital can't be affected. What about option B? Purchase of inventory on credit. How would we journalize when we buy inventory on credit? we would debit our purchases, which is mainly because our inventory as an asset has increased. And when assets increase, we debit them. And simultaneously, we would be crediting our supplier from whoever we bought the inventory on credit, because now we have an obligation to pay the supplier back at some point in the future. Therefore, it is a liability. And when liabilities increase, we credit them. So based on the second transaction, we can understand assets are increasing, but also liabilities are increasing. Therefore, capital is not really increasing, right? What about option C? Purchase of machinery by check. When you buy a machinery by check, your assets, which are the machinery as a non-current asset, are increasing in value. Therefore, you would be debiting machinery to say that assets are increasing. But simultaneously, you would be crediting bank because the funds available in your bank account are decreasing, which is also an asset. And when assets decrease, we credit them. So we would debit machinery to reflect an increase in non-current assets, and we would be crediting bank to reflect a decrease in current assets. As you can see, there are no assets really increasing or current or liabilities decreasing. Therefore, option C is not also valid. But option D, transfer of vehicle to business from private use, is referring to an investment that we have made, an additional capital contribution. So when we transfer this asset into a business account, what's happening is that the assets in the business are increasing in value. And simultaneously, this is a capital contribution, which is also increasing because of the increase in assets, right? So therefore, the correct answer to select for option for number 2 is option D, all right? Transfer of vehicle to business from private use. What about question number 3? Carl, a trader, took goods from the business for his own use. These goods had cost $100 and $8 carriage had been paid for them to be delivered to the business. So this $8 carriage is referring to a carriage inwards, which is the cost of transportation of goods into a business, okay? So when we sell this inventory to our customer, we would obviously include the cost for carriage included with the purchase price of this inventory, so we can accurately determine our profit, right? But how would this be recorded in Carl's accounts in the books of the business? We understand that Carl took some inventory from the business for personal use. So what is the actual amount of inventory that we had lost from the business, inclusive the carriage, which should be added as part of the cost of goods sold? It is 100 plus 8, that is $108, right? Whenever there is any drawings made by the owner, it refers to reduction in owner's capital or reduction in owner's equity. Owner's capital or owner's equity, when it increases, we credit them. But now that there is some kind of inventory drawings, which refers to reduction in owner's capital, we have to debit it. So therefore, we would be debiting the drawings account by $108, which is the total of the cost price and the carriage inwards for the specific inventory that the owner has withdrawn, okay? Therefore, the correct answer to select for number 3 would be to debit Carl's drawings account by $108. Now, what about number 4? Shula's financial year ends on 31 March. On 1 April 2021, there was a credit balance of $100 in Yasmin's account in Shula's purchases ledger. What does this mean? Now, first of all, what is the purpose of having a purchases ledger? The purchases ledger includes transactions with credit suppliers. So when I say that it includes transactions with credit suppliers, it could be any purchases that we have made on credit, any returns we have processed with our suppliers, any payments that we have made with our suppliers, any discounts that we may have received from our suppliers, right? So basically, any transaction that involves a credit supplier is included in the purchase ledger. Now, based on the paragraph given to us, we understand that there is a credit balance at 1 April 2021 of $100. If an opening balance is credit, it must be a liability because liabilities by default are always credited, which again validates the fact that Shula, which again validates the fact that Yasmin is a credit supplier for Shula because Yasmin, we have a credit balance of 100, which means Shula owes money to Yasmin, okay? So that means Shula owed $100 to Yasmin, obviously because Yasmin is the credit supplier. What about number 5? Hasina buys radios from Nazneen at a list price of $10 each. Hasina bought 12 radios and was offered 20% trade discount and a 4% cash discount. 2 radios were faulty and were returned to Nazneen. What was the total of the credit note issued by Nazneen? All right. So what we can understand is that initially, when Hasina would have bought inventory from Nazneen, let's assume it is on credit because we have the term cash discount here, which means that it is on credit because the cash discount is only given by the supplier to the customer when the customer makes the payment at some time in the future based on agreed terms. Now, initially, when Hasina would have bought this 12 sets of inventory, how much would Hasina owe? So Hasina would buy these 12 sets of inventory, which are the radios, at a list price of $10 each. But because of the good relationship between Nazneen and Hasina, Hasina gets to buy them at 80% of the list price, which is after deducting the 20% trade discount, right? So Hasina would owe Nazneen $96 initially when the 12 radios would have been sold. But later we understood that Hasina returned 2 radios. So how would Nazneen record this in the books? So when those returns would be initiated by Hasina, 2 items would be charged at actually $10 multiplied by 80% because we need to make sure that there is no excess amount recorded. So based on what we already had initially, we are making the returns based on that amount. So 2 times $10, again times 80%, so that would be $16, right? So $16 of returns would be processed. So what was the total of the credit note issued by Nazneen? So credit note issued by Nazneen is referring to the fact that after Hasina has sent those 2 radios out, Hasina initiated the return process, right? So Nazneen received those items and they were like, okay, now we got to return them. And Nazneen therefore writes a credit note, which is issued by Nazneen to Hasina to confirm that these returns have actually been processed. Okay, so therefore the total of the credit note issued by Nazneen for returns made by Hasina is $16. All right. Now let's move to number 6. Which items would be recorded in the general journal of a bakery? So here you can see we are given 4 statements and our choice of answer selection has to be a combination of 2 of the statements. Now, first of all, let's understand the regular and routine transactions, which are the usual transactions that we can expect for a bakery on a day-to-day basis. Where would they be recorded? They would be recorded in special journals, which would be the purchase journal, the sales journal, the returns journal. The purchase journal would be recording any credit purchases. The sales journal would be recording any credit sales. The returns inward or outward journal would be processing any returns made by the bakery to their supplier or made by the customer to the bakery, right? What about any unusual transactions? What can be unusual for a bakery? For example, purchasing a non-current asset, which is a buy that we don't always do. We are buying it all of a sudden. That is what is mentioned in statement number 2. Purchase of a delivery vehicle on credit. Like, it is a big decision because of the substantial amount of investment that is necessary, right? Which is unusual to the day-to-day activities that a bakery generally performs, right? Which is to make bread and stuff. So we can say that unusual transactions, for instance, the purchasing of a non-current asset, is what we will include in the general journal, all right? Other than that, what other unusual transactions do we have in the statements given? Let's look into statement number 1. Correction of an error of principle relevant to an oven repair. So this is an unusual transaction. Why? What do we understand by an error of principle? So error of principle refers to transactions recorded as the wrong classification. For example, if you had repairs expense, you included it as the cost of a non-current asset. So the non-current asset and expenses are 2 different classifications, right? So if you are making a mistake where you are including the repairs cost as part of the cost of the non-current asset, this is an error of principle. So therefore, this is an unusual transaction, and this definitely doesn't relate to routine unusual transactions which are recorded in the special journal. Therefore, because it is an unusual transaction, it must go in the general journal. So the correct answer to select for question 6 would be statements 1 and 2. But let's also have a look at statement 3. Purchase of flour on credit. Isn't that obvious that we have a bakery business and flour is essential every hour to produce bread? Also look at statement 4. Returned by a customer of a faulty batch of bread. Again, this is referring to usual transactions of the business, which has to do with making bread and selling bread and getting breads returned by customers. So again, this is obvious because bread is a highly perishable product. So whoever runs the bakery knows that this could be possible where a customer may return faulty items for bread, right? So therefore, the unusual transactions are statement 1 and statement 2, as we have already discussed, and the correct answer for number 6 is A. Let's move into question number 7. Alicia entered the credit notes she received in March in the correct returns journal. How was this total of the journal recorded in the ledger at the end of the month? So if Alicia is receiving the credit notes, who is she receiving the credit notes from? And what is the purpose of receiving these credit notes? All right. Alicia must have initiated the return process for any items that she bought in the past from the supplier, right? And now she must have initiated the return process by calling the supplier and telling them about the fact that I'm sending some of the items which I've bought previously, okay? So when the supplier gets the confirmation from Alicia, the supplier issues a credit note to confirm that the returns have been processed, all right? So if Alicia is initiating the returns with the supplier, what does this refer to? It refers to the fact that Alicia had made purchases in the past, and now that returns have been initiated, it is purchase returns. Whenever we make purchases, we debit purchases because of the inventory being at current asset account increasing in value. But now that we are initiating returns and that the returns have been processed and confirmed by the supplier, we have to include this in the account for purchase returns, which should definitely be opposite to what we do when we buy inventory. Therefore, we would credit purchase returns, all right? So therefore, we are crediting the purchase returns account in the books of Alicia. What about number 8? Which item would not be shown on a bank statement? Now, when we think of a bank statement, you could go to your father's bank statements if you have, and you would see all the balances. It's always credit at the beginning. And what does that refer to? The bank statement is produced from the perspective of the bank. So from the perspective of the bank, if the opening balance is a credit, as you would see in your father and mother's bank statements, that refers to the fact that we actually have money in the bank, and from the perspective of the bank, it is a liability for them. That is why they're including it as a credit, all right? But it is an asset for us, for the people who actually have money stored in the bank account. Now, which item would not be shown on a bank statement? Starting with option A. A check returned by the bank marked as referred to drawer. This is normal, I would say, because a check returned by the bank is referring to dishonored checks, where, let's say, like whenever you want to process the check, whoever gave you the check didn't have enough money in the account, so therefore the check got dishonored or bounced. Then you have a monthly payment made for electricity by direct debit. Absolutely. This is to be included in a bank statement. What do we understand by direct debit? So if your parents have the bank applications downloaded in their phone, and if you are used to using their phones, you would see at times you get notifications from the bank for automatic payments that may have been deducted, let's say for gym, or let's say for rent, all right? So this is a direct debit, which is an automatic payment already been set within the system. So therefore, this is to be done on a recurring basis, probably every month or every 2 weeks, depending on whatever arrangements you have. So this is to be definitely included in a bank statement. What about option C, bank charges? Definitely. So if you have stored money in the bank account, there is a fee that the bank charges, and therefore it is to be reflected in the bank statement because it is deducted automatically from the balance you have in the bank. And lastly, we have got unpresented checks. Never ever in a bank statement you would see unpresented checks. Unpresented checks are only recorded in the bank reconciliation statement, which is basically reconciling the bank statement balance with the cash book balance that we have for the business, right? Unpresented checks refers to the fact that checks that the business already included in the books as expenses that they have deducted, but these checks have been presented to the bank who has yet not accounted for this within the balance they have from their perspective in the bank, if that makes sense. So the correct answer for number 8 would be to select unpresented checks, which is never included in a bank statement, but rather in a bank reconciliation statement. Now, what about number 9? Which statement about a purchaser's ledger control account is not correct? Before we read through the options given to us, what is a purchase ledger control account? It includes all the credit transactions we have got with our credit suppliers. Again, it could be any purchases we have made on credit, any discounts we have received from our suppliers, any payment we have made to our suppliers, right? So it is quite clear that the purchase ledger control account is only for credit transactions, 100%, isn't that so? So now let's read through the options. Option A, it acts as a check on the balance of the purchaser's account. Okay, now the purchaser's account in itself will include both the cash and credit purchases. Isn't that so? Right. So therefore, we know for sure that it is option A, which is incorrect, and that's the one we would be selecting. But let's read through options B, C, and D. It includes transactions relevant to all credit suppliers, 100%, absolutely, we have validated that. It is prepared using information from the books of prime entry. Absolutely. So books of prime entry refers to the initial point of recording transactions, such as credit purchases or like purchase returns that would be initiated later. What about option D? It provides proof of the arithmetical accuracy of the purchaser's ledger. Not necessarily, because the arithmetical accuracy of the purchaser's ledger is also dependent on the recording of transactions by the bookkeeper in the journal before transferring those balances from the journal to the ledger, right? So therefore, as we can confidently understand that a purchase ledger control account can only involve credit supplier transactions, therefore it cannot include cash transactions or cash purchases. Option A for number 9 is what we will be selecting, okay? It acts as a check on the balance of the purchase account, which is incorrect. Now let's go to number 10. Javed's sales ledger control account had a debit balance of $12,000. Interest on an overdue account of $40 and discount allowed of $150 had been omitted. What was the correct balance on the sales ledger control account? Now, when we think of a sales ledger control account, it includes all the transactions with credit customers, right? So therefore, credit customers are considered as an asset for the business because these are people to whom the business has sold items on credit, and these customers have promised the business that we would come back and pay you. Therefore, from the business's perspective, economic benefits are attached to this, right? Therefore, it must be an asset. And all assets by default are always debited, which means their opening balance must be debited, which means whenever they increase, they must be debited. So if we are given an opening balance, or let's just say a debit balance of $12,000, right? That is referring to the fact that this amount is owed by customers. So when we have got interest on an overdue account, which is $40, that refers to the fact that some of the customers have failed to make the payment on time to us, but business is business, right? So because they failed to make the payment on time, there is an extra amount that these customers would now have to pay, which is known as interest. So therefore, this $40 would be added to $12,000 as we have done here. What about discount allowed? So discount allowed is a cash discount that the business incurs when the customer makes a payment, mainly for prompt payment. If a customer has made a payment by the due date, then we are very generous and we allow them a discount allowed. Therefore, this is going to decrease the amount owed by the customers and therefore is subtracted $11,150. So that leaves us with a correct balance of $11,890, which is therefore option B. Okay. All right. Now let's go to number 11. What is the effect of treating an item of capital expenditure as revenue expenditure? Okay, first of all, think about the difference between capital and revenue expenditures. Capital expenditure refers to the purchase of a non-current asset and adding value to an existing non-current asset, right? So what do we understand by adding value? Let's say, for example, you have a land, and on that land, you have a factory or a warehouse. And because your business has been so awesome, you decided to extend your warehouse and factory. So when you build that extension, it is adding value to your business in the sense that now your operational, you will experience operational improvements, right, and efficiency. What about revenue expenditure? Revenue expenditure refers to the day-to-day operational expenses of the business. So it's the regular operational small costs or costs such as rent, electricity, wages that we think about. So if we treat an item of capital expenditure as revenue expenditure, we are understating our non-current assets. Isn't that so? And because we are understating our non-current assets, we would be calculating the depreciation incorrectly. Therefore, the depreciation expense would also be understated. Isn't that so? Okay. So we have to go through these statements, and you would see it's option 2 and option 4. Cost of non-current assets is understated. Depreciation is also therefore understated, as depreciation is most cases derived by applying the given rate with the cost, right? So the correct answer for number 11 is option D, which is statements 2 and 4. All right, so let's go to number 12. Why does a business provide for depreciation on non-current assets? Now, depreciation, I'll give you the accounting concepts which validate the recording of depreciation. First of all, it's the matching concept. And the matching concept is simply that revenues that we have earned during the year, they're matched against the expenses incurred. Now, when we buy non-current assets for our business, what is the purpose of buying these non-current assets? We buy these non-current assets so they can add value to our business. And that value is extracted through the consumption of economic benefits from these assets to help the business generate more revenue, right? The purpose of business is simply business. So if I'm buying assets, I better buy it so it can help me make more revenue, right? So therefore, the matching principle states that revenues earned are matched against expenses incurred. That is one reason for why we include depreciation. A second accounting concept would be the accrual basis, which makes sure that expenses are to be recorded whether they are paid for cash or whether they're not paid for cash, as long as they're incurred in the process of generating profit, right? So if we were to utilize these two concepts that we've talked about, the correct answer to select would be option C, which simply states that the matching principle is applied when preparing financial statements, which we have discussed regarding revenues earned matched against expenses incurred, where the asset goes through a phase of wear and tear to help the business make more revenue, okay? All right, if you go through the other options, none of them would really make any sense. So let's go through the first option. To charge the cost of non-current assets against profit in the year of purchase. Why is this wrong? We can't really charge the entire cost of the non-current asset in the year of purchase. It has to be evenly distributed over its useful life if you're using the straight line method, or distributed using different economic consumption from earlier years of usage if you're using the reducing balance method. Option B, to ensure that non-current assets appear at book value in the statement of financial position. This could be right when you read through it, but we don't want to include it because it doesn't quite answer the question, why does a business provide for depreciation of non-current assets? Why is mainly like, what's the cause? What's the reason that these assets will lose value, which is known as depreciation, that we should be recording in the books? The main cause is that these assets were bought so that they can be used in the business to help the business generate more revenue, right? So Option B is quite basic, so I wouldn't be really selecting that. But option C, as we've already discussed, which talks about the matching principle, clearly justifies why we calculate depreciation. What about option D? To retain cash in the business for replacement of non-current assets, it actually doesn't make any sense at all. Like, how are you going to retain cash when we are deriving depreciation? Like, it doesn't make any sense, right? So therefore, for number 12, the correct answer to select is option C. What about question number 13? Machinery which had cost $6,290 was sold for $3,100. The disposal account showed a profit on disposal of $584. How much was the depreciation up to the date of disposal, and on which side of the disposal account was it recorded? All right, so if I could have your attention to the right-hand side where we have got all the workings. First of all, whenever we want to derive the net book value of an asset, we calculate it as the difference between the original cost and the total provision for depreciation, also known as total accumulated depreciation or total depreciation up to date. Okay? And the net book value, therefore, simply refers to the economic benefits still available for consumption by the business to help the business generate more revenue. Okay? Now, profit on disposal. When can we have a profit on disposal? When the proceeds from disposal, which is the money that we receive by selling the asset, surpasses the net book value of the asset. All right. So here you can see we have an equation. Profit on disposal can be calculated as the difference between the money that we receive by selling the asset, which is referring to the proceeds from disposal, and the net book value. Okay. Now, the profit on disposal is given to us at 584. The proceeds from disposal is 3,100. Clearly mentioned in the first sentence of the question. The net book value is what we are interested in finding. So if we make net book value the subject, then we can just simply find the difference between the proceeds from disposal and the profit on disposal, which is to subtract 584 from $3,100, and that will give us a net book value of $2,516. Okay. Now we want to use the equation for net book value to calculate the total depreciation, where we make total depreciation the subject. So if we make total depreciation the subject and the point of interest, then that can be easily derived as the difference between the cost and the net book value. And the cost is given to us at $6,290 in the first sentence of the question, and the net book value is what we derived to be $2,516. That gives us a total depreciation of $3,774. Okay. Now, most students, excellent students, they are able to derive this amount correctly. But what they end up making a mistake is whether or not it's a credit or a debit in selecting the answer for number 13. And many students have made a mistake, even after calculating the correct amount, and therefore lost marks. So how can we ensure that we don't lose marks? Now think about it. When we have provision for depreciation, what is it? It is a contra asset account in classification. And what is the meaning of a contra asset account? A contra asset account records all the reduction for a relevant non-current asset account, and the relevant non-current asset account in this case is the machinery. So whatever wear and tear and obsolescence and the loss in value the machinery would have gone through, they would be stored in a separate account, which is the provision for depreciation account. And that account, being a contra asset account, refers to the fact that it must have an opening balance of credit, because it is not an asset, it is a contra asset, right? So now that we have disposed this asset, and given that the provision for depreciation account is a credit balance account by default, how should we record this in the books? We have to remove the total depreciation for the asset that we have sold. So when we remove the total depreciation, the contra asset account would need to be reduced. Therefore, it would go from a credit to a debit. So if we are debiting the provision for depreciation, the simultaneous entry must be in the disposal, because we are debiting depreciation only because we have sold the asset, which is the disposal, right? So in the disposal account itself, the ledger account for disposal would be credited, mainly because of the provision for depreciation. So that means we would be selecting 3,774 on the credit side, as the question clearly specifies on which side of the disposal account was it recorded. Therefore, for number 13, the correct answer to select would be option C. All right. Okay, let's now do number 14. The following ledger account appeared in the books of a trader. So we are given the rent receivable account, which is based on the rent income that we can earn during the financial year. So you will see that we have got an opening balance on the credit side of the ledger account and a closing balance on the debit side. So obviously we understand this is referring to rent income. So when we have got an opening balance of the credit side of a ledger account, what can have an opening balance? Liabilities, right? So opening balance on 1 Jan 2020 of $400 credit is referring to an obligation, which is mainly the rent that we have received in advance from whoever we have rent our place to, okay? So therefore, it is an obligation for us and a liability, and that is why it's on the credit side. And during the year, we received additional cash from our tenant, and because it is rent income, it must be credited whenever there is an increase, because income accounts by default are always credited, contrary to how expenses are always debited, right? So as you can see on the credit side of the ledger account for the year ending 31 December 2020, we're recording the fact that we received cash for rent income, which is 3,600. And then again, at the end of the year, we can see that we have a closing balance of 600 on the debit side, again, which represents a liability or rent that we have received in advance or prepaid rent, whatever you want to call it. But there is a deficit on the debit side, and that deficit is $3,400. What is that deficit referring to? The transfer of the rent income that we have actually earned to the income statement as part of the closing entry. When we perform closing entries for income accounts, we have to debit the income accounts. Why? Because income accounts are temporary in nature. But we know that income accounts are always credited when they increase. But now that we are transferring the balance from the income account, where are we transferring it to? We're transferring it to the income statement for the purpose of reporting as part of our closing entry. Therefore, the income account would be reduced and the income statement account would be increased. So we'll be debiting rent income and we'll be crediting income statement, right? So that is essentially what we have done in the ledger account itself. We have shown $3,400 credit for the entry, which mainly refers to rent income that is earned by the business. And any income that a business earns is always credited. And because this is an earned income, it must be included in the income statement as part of the matching principle, where we calculate profit accurately, ensuring that revenues are matched against expenses income. So the correct answer to select for number 14 would be option A, 3,400 credit. All right, now let's do number 15. Why does a business maintain a provision for doubtful debts account? Now, we could just go straight to the point and select option A to apply the accounting principle of prudence. But what is the meaning of prudence? The prudence accounting principle states that assets are not to be overstated, liabilities are not to be understated, expenses are not to be understated, and consequently, profits are not to be overstated. So, if we are maintaining a provision for doubtful debts, what do we really mean by that? So a provision for doubtful debts refers to the likely amounts that we may not be able to collect from our credit customers, okay? And this is mainly an estimate, an assumption, which is based on historical events that we had gone through with some of the credit customers to whom we have sold inventory in the past on credit. So when we maintain a provision for doubtful debts, using the prudence concept as we have discussed, we are ensuring that we are not overstating our assets, which are the trade receivables, the credit customers of the business. And we're also ensuring that expenses are not understated, because when we include a provision for doubtful debts, we're actually taking a precautionary measure and being safe, which is what we're including as part of our other expenses in the income statement. not understating expenses, as a result of which profits are not also overstated. Okay, so the correct answer to select for number 15 would be option A. What about option B? To avoid profit for the year being understated. I mean, if you have a provision for doubtful debts, it's actually increasing your expenses. So when you increase your expenses, you would actually reduce your profits. We are not really avoiding for the profit to be understated. We are rather taking a precautionary measure to ensure that expenses are not understated. Okay. And what about option C? To have an accurate forecast of debt. You can't never have an accurate forecast because it's a provision, it's a contingency measure, it is some kind of estimate to reduce the expense of irrecoverable debts in the future. Again, this has no relevance to a provision for doubtful debts. Why? Because an expense account is temporary in nature. It cannot be carried forward to the future. It must be closed and finalized within the same financial period. Okay, so therefore for number 15 we stick to option A. What about number 16? How should inventory be valued? Always remember, it is valued at lower of cost and net realizable value. What do we understand by net realizable value? The net realizable value refers to the difference between the selling price and selling expenses. What do we understand by selling expenses? Let's say you had got a batch of inventory that was left in your warehouse, and because of the passage of time, it went through obsolescence where it is outdated, and now you need to spend some money on repairs to bring the inventory fit for the purpose of selling. So that is a selling expense, right? So that is what you'll be using when you derive the net realizable value. But always assess whether the cost is lower or the net realizable value. Whatever is lower is definitely the inventory value that you should be reporting in the balance sheet and also as part of your cost of goods sold calculation in income statement. In this case, for number 16, the option to select is C. What about number 17? What are the advantages of being a sole trader? So sole trader refers to one person running a business entirely by himself, where he does everything within the business. Can he easily raise finance? Definitely not, because I wouldn't trust someone who is running the business by himself that he would be managing my money properly and investing it properly, because you don't have enough brain power to actually run the business when you're doing multiple activities within the business, right? So therefore, it's not going to be easy for him to raise money. That's for sure. So on that basis, option A and option C can easily be canceled out, as we have done initially, okay? But is he entitled to all profit because he is the only person in the business? Definitely. Does he have total control? Absolutely. So what about, does he have unlimited liability? No. Why? Because his personal assets are at risk. So if someone sues him for any products or any services that he may have sold, and he loses the battle in court, then he will lose all his personal assets. Therefore, he does not have unlimited liability. So the correct answer to select would be that he is entitled to all the profit and he has complete control, being the sole guy in his business, so which would be option D. All right? Okay. What about number 18? Which items would appear in the income statement of a service business? So when we think of a service business, it cannot have an opening inventory, nor it can have any closing inventory, nor it can have any purchases. Therefore, there is no point of deriving the cost of goods sold because it is not a product business, it is a service business, right? Our revenues are entirely based on the services or the fees that we charge. Now, if there is no cost of goods sold, there can never be any gross profit, because gross profit is simply the difference between revenue and cost of goods sold. So on that basis, option A and B would be initially canceled out. But definitely there has to be a profit, right? But there can't be a surplus. Why? Because surplus is the term we use mainly for clubs or where we have subscriptions involved, which are mainly not for profit organizations. It's just a club, and the subscriptions are charged to members, and whatever surplus we have got, it is just transferred to the accumulated fund. It is not really part of a proper business. All right. So on that basis, option C is the correct one to select for number 18. Okay. Now let's go to question 19. A business provided the following information. What was the total of the current liabilities? Now you can see that we have been given a list of items, and let's understand what each of these items are. Starting with the first one, long-term loan, non-current liability, long-term. Obviously, this loan is not due for repayment in the next 12 months. So this is a non-current liability. Trade receivables, current assets. These are the credit customers of the business. Trade payables, current liability. Bank overdraft, current liability. Bank overdraft refers to withdrawal of funds for emergency purposes by the business, but this amount must be paid back in the next 12 months. Therefore, it falls within the classification of a current liability. Prepaid insurance, current asset. This is an expense paid for in advance for next financial year. Accrued wages, current liability. Your staff or your employees, they have actually done their job and worked for you, but you owe them money. So that is accrued wages. What about rent receivable prepaid? This is also referring to rent that you've received in advance from your tenant, possibly for the future financial periods. Okay, so again, this is a current liability. So what you can do simply is add each of those four together and you should get 13,200. Therefore, option A would be the correct answer to select for number 19. Okay, all right. Now let's do question 20. What is added to owner's capital to calculate capital employed? Always remember, capital employed is simply non-current liabilities plus owner's capital or equity. So capital employed is mainly referring to how much capital that have we invested, that we look forward to keep on investing on a longer term horizon. So that is obviously the total of non-current liabilities and owner's capital. And therefore option D is what we will select for number 20. Okay. Now let's go to question number 21. All right, so let's see what's going on. On 1 April 2020, Ahmed had a provision for doubtful debts of $290. The following journal entry was made on 31 March 2021. So on 31 March 2021, you can see as part of the closing entry, the provision for doubtful debts is being debited and the income statement is being credited. What does that refer to? Now, we have already discussed that the provision for doubtful debts is a contra asset account. And what do we understand by a contra asset account? It is an account that must have an opening balance on the credit side. And the reason it has that is because it is an account which records all the reduction that is possible for a relevant asset account, which is the trade receivables account. And the provision here refers to the amounts that we may not be able to collect from our credit customers, right? Some kind of contingency measure. Now, if the income statement is being credited, always think about it as a good thing. So when we are crediting the income statement, it is actually referring to the fact that profits are going to increase, all right? And profits can only increase when expenses decrease. And when can expenses decrease? When there is a reduction in provision for doubtful debts. Because when there is a reduction in provision for doubtful debts, it is a good thing for the business because now you expect to lose less money from your credit customers. So there are less expenses that you expect to incur. Isn't that so? So because there is a reduction, it is a good thing. It is increasing your profits, and that is why income statement is credited. So if it is a good thing, and you started with a balance of 290, now that balance of 290 would be reduced by 25, obviously, and that will give us 265 as the final balance available for the provision for doubtful debts, which is valid at the end of the year on 31 March 2021, which we'll be including in the balance sheet or the statement of financial position when we show the trade receivables at gross amount less the provision for doubtful debts of 265. Okay. All right. Now let's start with question number 22. X Limited started the year with an ordinary share capital of $100,000 An ordinary share dividend of $3,000 was paid during the year. Later, a further $10,000 of ordinary shares were issued. The profit for the year was $8,000. By how much had equity increased at the end of the year? So based on the first 4 sentences that we have read, let's use a logical approach to determine the total equity that we could have at the end of the year. Starting with the initial investment of $100,000, then we invested additional $10,000, right? Then we made profit of $8,000, which is going to increase the total retained earnings. And then we paid out dividends from the retained earnings, which is therefore minus $3,000. That should give us an ending equity balance of $115,000. So we started the year with $100K. We ended with $115K. So there is an increase of $15K. Therefore, the equity had increased by $15,000 by the end of the year, which is option C. All right. Now, let's do question 23. I've been speaking consistently for multiple videos. So yeah. All right. So question 23. Which providers of funds to a limited liability company received a fixed rate of return on their investment? Okay. Ordinary shareholders are the common shareholders. It is referring to the general public. Let's say, like there is a company. If you're based in Dubai, and let's start with any company, random company, which is listed in the stock market. That is why it is a limited liability company. Now, ordinary shareholders could be anyone from the general public, okay? And the dividends that we pay out to these ordinary shareholders are never fixed. It is dependent on the company's performance, all right? What about the preference shareholders? Preference shareholders are the big guys, like the board of directors people, or the people who invested a substantial amount of capital to get the company up and running initially, and also when it was listed in the stock market, right? Okay, so these people who have invested the big bucks, they are entitled to preferred dividends, which is always a fixed rate of return every year. Regardless of whether the business makes profit or not, it would be taken out from the cash and paid to them. Obviously, depending on the board of directors meeting, that's A-level stuff you don't have to worry about. But what you have to know is that preference shareholders are the big investors who initially invested money in the company to get it up and running and then eventually listed in the stock market, all right? And these guys, being the big dudes, they're always entitled to a fixed rate of return. What about debenture holders? These are the people who have lent huge amounts of money to the company, and this is obviously not for free. There is a finance cost involved, which is the interest expense that the business incurs, right? And that is also a fixed rate of return because it is contractually bound. Business is contractually bound to take care of all those interests, all right? So we'll be excluding ordinary shareholders, including preference shareholders and debenture holders. So that would be option C. Okay. Question 24. Every member of a sports club is required to pay an annual subscription of $50. The subscriptions account showed the following. Now, when we think of the subscriptions account, it is basically the revenue account for a club, all right? And the question is asking, what was the increase in the number of members in areas between 1 January and 31 December 2020? Let's first understand what is subscription in areas. Subscription in areas refers to members who owe subscription fees to the club for benefits or facilities that these members have already enjoyed in the previous financial year. And this is therefore a current asset for club because the club expects to receive this amount from the members. So starting at 1 Jan 2020, you can see that we have an opening balance of 350 on the debit side. That is definitely an asset because all assets must have an opening balance on the debit side. Given that each member pay $50, and given that we have $350 in opening balance for areas, we have 7 members altogether, right? And then if you check the closing balance at 31 December 2020, all right, you will see we have $750, which when divided by $50 per member would mean that 15 members owe us money. So there is an increase from 7 to 15 members, which is an increase of 8 members. And that is the answer for question 24, which is option C. But let's understand some things first. So we know that subscription in areas is a current asset for the club. And all assets must have an opening balance on the debit side. All liabilities must have an opening balance on the credit side. Okay? Therefore, all assets, logically speaking, must have a closing balance on the credit side, and all liabilities must have an opening balance. Opening balance on the credit side and a closing balance on the debit side. Okay. Now, we started the year with a balance brought down of 350 on the debit side of the ledger account, which is definitely a current asset for the club, referring to subscriptions in areas for fees that members have not paid for benefits which they have already taken in the previous financial year of 2019. All right. And you can see at the end of the financial year at 31 December 2020, the closing balance, which is represented by balance carried down of 750, as it is included in the credit side, fits within the criteria of assets always having a closing balance in the credit side. Therefore, that is also a subscription in areas. Okay. And you can see there is an increase from 7 to 15 members, which is why we're selecting 8 members. All right. Now, be careful of how you select your choice of answers in the exam. But there is also another balance carried down here. What is that? That's my question to you. That is recorded on the debit side at 31 December 2024, 50. That is referring to subscriptions received in advance. So when we have got subscriptions received in advance, it is an obligation upon the club to fulfill the services in the next financial year, right? And how do we determine that this is subscriptions received in advance? Because it is clearly recorded on the debit side. And how do we know it's a closing balance? Because it clearly specifies balance carried down. So therefore, it must be a liability, okay? So that is not a subscription in areas. So that's what I need you to understand when you answer this question. All right, let's go to question 25. Which term is used to describe the surpluses that have been earned by a club over its lifetime? It is always accumulated fund, because surpluses refer to the excess amount, which is what you know as profit if you were having a proper business. But a club is not a business. It is a non-profit organization purely surviving to take care of the members, right? So all the surplus of the profits that have been generated, they will be transferred into the accumulated fund. So whenever you're working with clubs or subscriptions, it is an accumulated fund, okay? Which is also the same thing as equity that we have or capital that we have for our business, okay? So it is option A for 25. Now, what about 26? NULA provided the following information for the year ended 31 March 2021. So you can see we are provided with the drawings for the year, and then we're given the opening net assets and the closing net assets. We are required to find whether or not we've got a profit or loss for the year. Now, what do we understand by net assets? Net assets is simply the difference between total assets and total liabilities. And net assets is also synonymous to owner's capital or owner's equity. Now, let's just use some logic here. So we started the year with an opening net assets of 60,500, and we ended the year with 72,275, which means the difference is 11,775. That is the increase in net assets or increase in equity, right? Now, the drawings that we have been given of $3,900, that will definitely reduce the net assets, because drawings mainly refers to reduction in owner's equity. And drawings can only be done in most cases, or 99.99% of the cases, after a profit has been made. So the drawings have already been done and have been factored in the calculation of this final balance of 72,275. So if the change we are noticing is 11,775, then the profit, if you add the drawings back, must have been 15,665, from which 3,900 would have been withdrawn as drawings to end us to leave us with $11,775 that validates the increase in net assets. Okay, so we have got a profit of 15,675, which is option D for number 26. Okay, let me just fix this quickly. 675. Okay, number 27. A trader who does not keep full accounting records was able to supply the following information. How much were the credit sales for the year ended 31 March 2021? So whatever information we're given, they're all relevant to trade receivables. So therefore, we can prepare the sales ledger control account, which records all the transactions with credit customers. So we have a sales ledger control account, as you can see on the whiteboard on the right-hand side. And we have the opening balance, which is balance brought down at 1 April 2020 of $3,000 recorded on the debit side, referring to the fact that this is the amount owed by customers. And then we have our closing balance recorded on the credit side, because obviously this is an asset and all assets must have a closing balance on the credit side, and also referring to the amount owed by customers at the end of the year, which is 4,200. You will see that during the year we have received checks from trade receivables, which is 28,000. So when we receive checks, the money owed by our customers decreases. Therefore, it is recorded on the credit side, with the cross-reference being used as bank and $28,000 being the amount we received. We also know that we have given cash discounts of $1,500, which is referring to discount allowed, which would reduce the amount owed by these customers and therefore is recorded on the credit side, and that is $1,500. Okay. So the yellow highlighted amount is what we found by inputting all the information we've got and then calculating the deficit or that is remaining on the debit side. So let's add everything that we've got on the credit side, which is 28,000, 1,500, and 4,200. That gives us 33,700. Based on the fundamental rules of accounting, this must be the total on the debit side as well. And once we subtract the opening balance of 3,000, what we're left with is $30,700 as the amount for credit sales. Okay. And therefore, the correct answer to select for number 27 would be option D. All right. Question number 28. Let me just drink some water, please. Okay. All right, so let's start with question 28. A trader provided the following information. A markup of 25% is applied. What were the purchases for the year? All right, so markup is given to us at 25%, and the markup is calculated as the gross profit divided by cost of goods sold. So gross profit divided by cost of goods sold is given at 25%. Gross profit can then be derived by writing the revenue and subtracting the cost of goods sold. All right. So what we're now doing is replacing all information that we already have within this equation. So the revenue is 120,000. The cost of goods sold, we have just assumed it to be X simply. And again, we are replacing the denominator with X just for the purpose of making it look simple. That equals 25% as the markup. So 25% multiplied by X gives us 0.25X, to which we add this X that makes it altogether 1.25X. That must equal $120,000. All right. So X is therefore 120,000 divided by 1.25, which is 96,000. All right. So $96,000 is the cost of goods sold. Now, the cost of goods sold can also be derived, as you may have seen tens of or hundreds of times in the income statement, is opening inventory at purchases less closing inventory. So we're replacing the cost of goods sold with 96,000, opening inventory as given in the table to be 9,600, purchases are what we are after, closing inventory is 10,200. So we just simply use algebra and you'll derive a purchase amount of 96,600, which is therefore option D. Now, let's go to question 29. All right. George provided the following information. His liquid or asset test ratio was 1.2. What was his bank overdraft? First of all, what is the formula for asset test ratio? Asset test ratio is calculated as all current assets excluding inventory. All right. So in the numerator, it's all current assets excluding inventory divided by the current liabilities in the denominator. Okay. Now, all current assets excluding inventory would be only the trade receivables. That is $80,000, which is what we have input here. And all current liabilities, there are trade payables of 8,000 and the bank overdraft, which we have assumed to be X, that we look forward to derive. This must equal 1.2, which is the asset test ratio. So how can we derive it? Here I have elaborated the steps, unlike the previous question for algebra. So see and understand how we derive X, which is the bank overdraft. So 8,000 plus X multiplied with 1.2. So 18,000 must equal that. So then 18,000 is equal 9,600 plus 1.2x, where we are multiplying everything within the brackets by 1.2. Then if we make 1.2x the subject, then 18,000 and 9,600 would be calculated. So 18,000 minus 9,600, that's the difference we have got. So then X is simply 8,400, which is the difference between 18,000 and 9,600 divided by 1.2, that is 7,000. So bank overdraft must be $7,000, okay? All right, so if you're confused on how we went from this step to this step, it's very simple. You can just rearrange this sentence like this. And that is the same as the previous statement where the left-hand side is equal to the right-hand side. And again, the right-hand side is equal to the left-hand side. It's the same thing. And if you make 1.2x the subject, then you would have to send the 9,600 on the other side and make it a deduction from the 18,000. All right. In case you're confused, which I believe you shouldn't be. All right. Now, let's go to question 30. A trader provided the following information. It was found that the closing inventory should have been $400. What was the correct rate of inventory turnover? All right, so this amount included here is wrong. Okay, this should be 400 instead. Now, first of all, how do we derive inventory turnover? So inventory turnover is simply cost of goods sold divided by average inventory. Cost of goods sold is opening inventory at purchases less closing inventory. And average inventory is simply opening inventory at closing inventory and dividing by 2. It's obvious because it's average. So now what we do is replace all this stuff with the numbers that we have. So opening inventory is given to us at $100. Purchases are given to us at $2,600. The correct and the revised amount of closing inventory is $400. The entire thing divided by 100 plus 400 being the total of opening and closing inventory divided by 2, which is basically finding the average. So $2,300 in the numerator and $250 in the denominator gives us 9.2 times as the inventory turnover. So therefore, the correct rate of inventory turnover is option C. Mainly what you have to know is the inventory turnover correct formula. All right. Okay, so let's now understand question 31. The current ratio of X is 2 to 1. All right. I'm sorry for that. And the current ratio of Y is 1.3 to 1. What does the comparison of these ratios show? Now, current ratio is calculated as current assets divided by current liabilities. So if X has a current ratio of 2 to 1, it is quite obvious to say that X has twice the current assets than current liabilities. Do you agree? Okay. And If Y has a current ratio of 1.3, that means Y has 1.3 times the current ratio than current liabilities. All right, let's start with the first option. Option A, X has fewer liabilities than Y. And can we really say whether X has fewer liabilities than Y? And again, when you check option C, it says Y has fewer current assets than X. We don't really know. We can't really validate for sure whether they have fewer, because the comparison is between X and Y. And the trick in this question is that you need to understand this from a monetary perspective. Let's just assume the current ratio of X, which is 2. If X has current assets of $200,000 and current liabilities of $100,000, $200,000 divided by $100,000 would give a current ratio of 2. But if we think about Y, assuming that Y has total current assets of $406,000 and total current liabilities of $400,000, when you divide 460 with, 520 let's just say for Y, we have current assets of $520,000 and current liabilities of $400,000, right? So when you divide 520,000 by 400,000, we get 1.3 as the current ratio for Y. But what I'm trying to make you understand is that you can see that the dollar amounts for the current assets and current liabilities are different between the two companies. So therefore, you can't really check and validate whether X has fewer liabilities or Y has fewer assets. But simply, you could use the ratio to make an assessment in terms of the overall liquidity, because you don't know the ins of the business in terms of the numbers available, right? So on that basis, option A and C won't make sense because we don't know the monetary amount. So we can't really say for sure that it has fewer liabilities or fewer assets, all right? And again, for option D, Y has more inventory. Like, we don't really know the dollar amounts involved. But when you select option B, which is the correct answer, it says that X is more liquidity than Y. So when we look at the current ratio of 2 for X, it is a clear fact that X is twice the current assets than current liabilities, and therefore they can easily take care of the short-term obligations. Therefore, it proves that this X company actually has high liquidity. So therefore, for number 31, the answer to select would be option B. All right? Okay, let's go to question 32. Which external parties would be interested in the financial statements of a trader? So when we read the word external, it's referring to people or parties outside the business. So within those given options, we need to assess which one is outside and which one is within. So statement 1, a bank manager considering a request by the trader for a loan. The bank manager is outside the business of the trader. It is an external party. Statement 2, a trade union seeking a wage increase for the employees. So trade union is also external to the business. Option 3, the business manager making decisions about how to increase profits. Business manager is employed by the business, therefore he works in the business, so he's an internal party. What about number 4? The trader deciding if drawings could be increased. So trader is obviously the guy who owns the business, right? So external parties are statement 1 and 2, which is option B. Very easy, this one. All right. Last 3 questions. You can say that my throat is dry. Yeah, but I'm happy to do this for my students. All right. So number 33. Sabina runs a retail business. She plans to close a business in a few weeks' time. How would the fixtures and fittings be valued in the statement of financial position? We know that in the balance sheet, whenever we prepare it, the non-current assets section mainly, we show the cost, then we show the total provision for depreciation, and then lastly, we show the net book value in the third column, which is derived as the difference between the cost and the provision for depreciation amounts. And the net book value is mainly in the statement of financial position because it gives a clear picture and a clear view of the economic benefits that are still available for consumption in the business. So when Sabina would close her business, as part of closing the business, she would want to sell these fixtures and fittings to an external party. And that external party would be interested in the usage of this asset and the remaining economic benefits that are available for consumption. Okay, so therefore book value is the correct choice, and therefore option A is what you would select for number 33. Number 34, why should a trader match his costs for a financial year with the revenues for the same period? To show the correct profit figure, obviously this is dependent on the matching principle, where revenues earned must be matched against expenses incurred. All right, and costs are obviously expenses for the business. And by doing that, we can derive an accurate profit figure because the expenses have been matched against the revenues which we have earned. An example that we had already seen before is the depreciation expense incurred through the consumption of economic benefits from within the asset, which helps the business generate more revenue by utilizing that asset. Okay. Now, what about number 35? The last one. Which international accounting objectives are described by the following statements? Okay, so statement number 1, information in financial statements must be free from material error and bias. So obviously we don't want any errors in these statements. So this clearly points to the concept of reliability. So you can see that options A and B don't have reliability included for statement 1. So on that basis, we could easily cross out those options first. So options A and D are crossed out. What about option D? Users must be able to identify differences and similarities between information in different financial statements. So this is referring to comparability, because when we prepare financial statements, we obviously prepare it for the current year. But if you had seen an annual report, which you will definitely see in the future when you're an accountant yourself or when you're working as a top executive in a company, an annual report shows the previous year's financial statements as well, because an annual report is presented to the investors, and the investors would likely want to know if the business has done better in terms of profit, in terms of expenses, in terms of assets, equity, liabilities, and want to make comparison from the previous year to the current year. And also these investors would be interested in identifying the trends, any similarities and any differences which could reflect or explain any difference in performance compared to the previous year. So obviously this is referring to the concept of comparability. So therefore for number 35, given that options A and D had already been crossed out, we're left with B and C, and B, which is reliability and comparability for statements 1 and 2 respectively, is the correct answer. Okay. All right. What about understandability? When do we use understandability? Understandability is here mainly referring to simplicity in presentation of numbers. So when the financial statements are presented, you only show the exact amounts relevant to that line item. You don't show all your background calculations or workings, right? Because the investors or people who want to invest, or potential lenders, they are not interested in the calculations. They just want to have a straightforward information of the numbers being presented. Okay. All right. So that's all for this paper. If you found value in this content, make sure to drop a like, subscribe to this channel, share it with your friends, post in the comments on any other past exam papers you would like me to complete. And if you're interested in preparing for the intensive program, given that your exams could be ahead in May, June 2026, be sure to check out the link in the description and submit a form and join our classes. And I'll see you in the next lesson.